Welcome to Study Session 9, Budgeting. Introduction. A budget may be defined as a plan quantified in monetary terms, prepared and approved prior to a definite period of time, usually using planned income to be generated and or expenditure to be incurred during that period, and a capital to be employed to obtain a given objective. When a plan is expressed quantitatively, it is known as budget. The lecture examines different types of budgets and related issues. Objectives. At the end of this lecture, you should be able to describe the nature and process of budget, as well as carrying out calculations that involves functional budget, master budget, and flexible budget. The fundamentals of budgeting. The fundamental concepts of budgeting include the underlying activities that must generally be carried out to attain minimum usefulness for budgeting. An outline of the fundamental concepts usually identified with budgeting includes the following: a management process that includes planning, organizing, staffing, leading, and controlling. An organization structure that clearly specifies assignments to management of authority and responsibility at all organization levels, that is, a responsibility accounting system. Continuous feed-forward, feedback, follow-up, and replanning through defined communication channels, both downward and upward. A behavioral management program. This should include development program of budget education to inform management at all levels about the purpose of the program, the manner in which it will operate, the responsibility for each level of management, the effect of the program on the performance of each manager's functions, and so on. Types or classification of budget. Budget is a plan showing expected achievement based on most efficient operating standards. Against this actual accomplishment is regularly compared. Budget can be classified as follows: 1. Based on time, short-term budget or long-term budget. 2. Based on functions, sales budget, production budget, administrative cost budget, selling and distribution cost overhead budget, capital expenditure budget, cash budget, research and development cost budget. 3. Based on behavior, fixed budget and flexible budget. Importance of budgeting. 1. Budgets communicate management's plan throughout the organization. 2. Budgets force managers to think about and plan for the future. In the absence of the necessity to prepare for a budget, many managers will spend all their time dealing with day-to-day emergencies. 3. The budgeting process provides a means of allocating resources to those parts of the organization where they can be used most effectively. 4. The budgeting process can uncover potential bottlenecks before they occur. 5. Budgets coordinate the activities of the entire organization by integrating the plans of its various parts. Budgeting helps to ensure that everyone in the organization is pulling in the same direction. 6. Budgets define goals and objectives that can serve as benchmarks for evaluating subsequent performance. The budgeting process. This refers to sequence of operations necessary to produce a budget for a particular organization. It will depend upon the type of organization and its perceived requirements for planning and control. There is no strict rule on how to prepare a good budget, but the following steps may be a useful guide. 1. Establish organization objective. 2. Prepare organization chart. 3. Create budget centers. This should include various departments like production, sales, and marketing. 4. Form budget committee. 5. Appoint budget officer. This is like a secretary of budget committee. 6. Establish budget period. 7. Identify principal budget factors. 8. Prepare budget manual. This will contain rules and regulations on the achievement of budget objective. 9. Prepare functional budget like sales budget, product budget, cash budget, and so on. 10. Prepare master budget, that is, budgeted income statement and balance sheet. The principal budget factor. When preparing a budget, each manager should review the element in the budget and identify where limiting factor or governing factor exists. They will not all be equally significant, but where a particular limitation is of major importance, it may be necessary to budget for that item first and to construct the rest of the budget around it. This can happen not merely in one department but for the company as a whole, where the item concerned may be referred to as principal budget factor, for example, sales. It is essential to identify the principal budget factor and any other limiting factor at an early stage in the budgeting process so that management may consider whether A. It is possible to overcome the limitation which they impose, for example, finding new market for sale or by obtaining alternative suppliers or substitute raw materials, or B. The limitation imposed must be accepted and the business budget must be produced within those limitations. The level of activity at which a business can operate will usually be limited by a number of factors, among which are market demand for its products or services, the number of skilled employees available, the availability of material, the space available either as a working area or for storage of goods, the amount of loan or credit facilities available to finance the business. Increase planned sale through sales promotion and advertising. Increase sales by offering better terms or lower prices to customers. Change product mix to increase volume of faster selling product. Sell off the excess production capacity. Preparing the production budget involves the following. A. Establish policies for inventory levels. B. Plan quantities of production during budget period. C. Schedule planned production by interim period. D. Determine activities of each responsibility center in the manufacturing process. The production budget is the initial step in budgeting manufacturing operations. In addition to it, three other principal budgets are relevant to manufacturing firms. A. The direct material and purchases component budget. B. The labor budget, which shows the plant quantity and cost of direct labor. C. The factory overhead budget, which includes the plans for all factory costs other than direct materials and direct labor. Material budget. Production managers must transfer the quantities in the sales budget into unit of production requirement for the budget period for each product while reconsidering management inventory policies. Factors determining inventory policies include quantities needed to meet sales requirements, perishability of items, length of the production period, storage facilities, adequacy of capital to finance inventory production, distribution time requirements, costs of holding inventory, protection against labor and material shortages, price decline, obsolescence of stock, casualty loss and theft. One thing that should be looked for when implementing material control is to see if stock or materials are larger than necessary. One method of stock control is the EOQ, Economic Order Quantity. It's a mathematical method of deciding what is the amount of stock that should be ordered at a time so that the cost of financing and keeping stock are kept down to the minimum. The formula is given below, where D equals consumption or usage or demand per annum in units. CO, cost of placing order. CC, cost of storage and holding of 1 unit per year. That is carrying cost. Expenditure budget. In planning expenditure level, the final benefit to be derived from such expenditures should be considered, and sufficient revenues must be planned to support the operating activities for their accomplishment. In planning expenses, a separate expenses budget for each responsibility center must be developed. The output or activity for each should be planned. All level of management should be involved. The cash budget. The cash budget ensures that sufficient cash is available when required. It shows whether or not capital expenditure project can be financed internally. It includes 2 parts: the planned cash receipt, inflow, and planned cash disbursement, outflow. Purposes of cash budget are: 1. It identifies excesses or shortage of cash by time periods. 2. It establishes the need for financing and the availability of idle cash investment. 3. It establishes a sound basis for continuous monitoring of the cash position. The cash budget is directly related to other budgets, such as the sales budget and expenses budget, as well as the capital expenditure budget. Example 1. Voda Furniture PLC has gathered the following data about future sales and production requirements for the year 2012. The data is shown below. Production's overheads are estimated at 500,000 naira per year. For internal management purpose, Voda Furniture PLC adopts a marginal costing system and therefore treats these overheads as a period charge. The management of Voda requires the following budgetary information for the forthcoming budget period: sales budget in monetary terms, production budget in units, materials purchased budget in units, materials purchased budgets in monetary terms, material cost per unit manufactured and sold, the total labor hours worked during the period, and the cost plus the labor cost per unit manufactured and sold, the unit contribution for each product, the profit or loss for the budget period, the value of closing finished stock at the end of the budget period. The solution is shown below. Note that opening stock plus production equals sales plus closing stock. Master budget. The master budget represents a consolidation of all support budgets and presents the financial effect of the total plan for the business as a whole. The master budget is usually presented in the form of budgeted trading profit and loss account and budgeted balance sheet. Each of the parts of the master budget is prepared in the conventional manner, except that budgeted costs, revenues, investments, and so on are used instead of historical figures. Example 2. Ortex Limited was formed on 1st July 2011 with a share capital of 40,000 naira. 24,000 of this capital were immediately invested into fixed assets, leaving 16,000 cash. The fixed assets Take 2. The fixed assets were estimated to have a 10-year life and will have no value at the end of 10 years. The company has decided to depreciate these assets using the straight line method of depreciation. Therefore, the depreciation charge per year will be 24,000 divided by 10 years, which is 2,400 per year, or 200 naira per month. Prior to starting, business plans have been formulated for the first 6 months of the first year of operation. These plans are set out below. Sales for the 6 months is estimated at 600,000. However, the company operates in a seasonal market and will also be allowing some of its customers to take credit. The company anticipates the following receipts of cash over the 6th period from sales. The material required to meet the demand for sales are estimated to be 240,000 naira. To enable the company maintain a stock, that is to ensure against any shortages, 260,000 naira worth of materials will be purchased in the period. However, because of the production cycle and the credit that the company will be obtaining from its suppliers, the pattern and amount paid to suppliers will be as follows. The estimated labor cost that will be incurred over the 6 months will be 180,000 naira. In addition, the firm anticipates that overhead, excluding depreciation, of 138,000 will also be incurred over the period. Overheads and wages will be paid evenly over the 6-month period. To ensure that sufficient cash resources are available, the company wishes to prepare a cash budget on a monthly basis as well as a budgeted profit and loss account for the period and a balance sheet at the end of the period. Note, you are to assume that any cash deficits are financed by a bank overdraft. The solution is shown below. Flexible budget. This is a budget that is designed to change according to the level of activity attained. It recognizes the existence of fixed, variable, and semi-variable costs, and it is designed to change in relation to the actual volume of profit or level of activity in a period. Example 3. Gamma Vegas Limited is a manufacturing business with several production departments. Thomas, the manager of the machining department, submitted the following figures for the firm's annual budget for his department. Total capacity for machining department 80,000 units. Actual production for the period is 68,000 units, and the costs are shown below. Thomas is being criticized for overspending 33,150 naira compared to his normal budget. It is appreciated that he has made a saving on heating and lighting but concern is being expressed over the spending on materials and labor required. Construct a flexible budget for 60%, 70%, 75%, 85% and 90% of production capacity. Calculate any savings or overspending by Thomas department and comment on its efficiency. The solution is shown below. Thomas is more efficient in the case of raw materials, direct labor, power, fixed heating and lighting, but repairs and maintenance, indirect wages and fixed insurance need to be investigated. In general, the system is efficient as most variants are favorable. Possible limitation of budget. 1. No budgeting system can replace the need for supervisory executive ability in major decisions. 2. Volatile environment make realization of budget difficult. 3. Budget places a great demand on management time. 4. It can encourage interdepartmental conflict. 5. It may take away management flexibility. 6. Lack of adequate and realistic data. 7. It could lead to demotivation if not properly done. Summary. A budget is a plan that is quantified in monetary terms, prepared and approved prior to a defined period of time. Advantages of budget cannot be realized without a sound management structure in place. Principal budget factors is the most important limitation that must be considered before preparing the budget. Functional budget is prepared for all functional units of the organization. Examples include sales budget, expenses budget, material budget, production budget, labor budget, cash budget, and so on. Master budget includes the budgeted income statement and balance sheet. Flexible budget accounts for changes in the level of activity. This is the end of study session 9. Thank you.